Hey, and we're live. Welcome, Kuppy, to Benny and the Squirrel.
Hey guys, happy to be here.
Listen, I'm not going to do much of an introduction. You are so visible in our world. But to anyone that doesn't know who Kuppy is the CIO of Praetorian Capital, which he manages from down in Rincon, Puerto Rico. Listen, a wonderful chance to have you on. Thank you so much.
Hey, thanks for the invite.
So, listen, all three of us are pretty bearish at the moment, and so let's not depress the hell out of everyone. I think we want to take a little bit of a step back to the other side of all of this. Okay, you know, how should we be behaving when we should be sitting on our hands right now? How do you prep yourself through this kind of period of time?
Well, when I'm bearish, I usually just take stuff off the books. I mean, you force yourself to sell stuff. Look, every couple of years, the market goes down a lot. And no matter how much exposure you have, it's always too much, because I always think my stuff's going to do better than the market, but it doesn't. And you want to be able to come at it from a position of strength when you buy whatever you're going to buy on the way back up. And it's a process. The day we started dropping bombs, I said, I'm taking some stuff off. The first thing I did, and this is, a process. There's a real process. And I like to say I've panicked for 10 of the last 2 crises. But, the first thing you do is you rip up your event-driven book. I mean, these are short-term trades that, you have a stop loss in place, usually a time loss in place too. I don't need these. I mean, I want to bet on my real macro bets. So I tear that up, that frees up some balance sheet. And then I start going through what I own. And I say, if the world gets a little weird, what's going to work? In this case, the world getting weird, it's oil going up. It's a bunch of commodities having weird events. It's supply chain disruption. I mean, who knows where this war takes us to? What's at risk? And I toss some things out of my book there. It just cleans up room, right? I just want to be able to come at this from a position of strength. You go buy some tail hedges. I mean, usually the cheapest, bang for the buck is some out of the money VIX calls. They usually go to VIX heaven, but if you hit them, you really hit them. I find you get more bang for the buck than buying SPY puts or something like that, just because the VIX of VIX explodes. I'm not saying mine is the right way to do this. It's just a way to do it. And then from there, you start analyzing the situation and you try really hard not to buy. Because as stuff starts dropping, your favorite names, you're like, let's average down. Let's buy 10,000 of this. It's down another 2%. Let's buy another 20,000. And pretty soon you've used up all your buying power right before the real drop. And so you just got to sit on your hands. I mean, look, I'm wearing my Finca Kuppy shirt here because that's where I'm going right after this. I go out there and farm, so I don't buy stuff. I go surf, so I don't buy stuff. You buy stuff when everyone on Twitter is crying. You don't buy stuff now where everyone's a 4-star general on Twitter and they're, analyzing the situation. Like, no one knows what's going to happen, including Trump. So what's the point of watching it? And he'll tweet, and we're going to move 2% every day until either something really bad happens or there's a resolution. And at some point, things will get really cheap, and I'll buy it. Until then, I'm going to sit on my hands, and I'm going to give back a couple bips seemingly every day. My stuff seems to it seems to be correlated with everything else, even though I'm long, the stuff that would be working. But look, I'm going to wait for it to be obvious. Otherwise, I still have a pretty big book. And if we miss it and I miss the turn and the all clear, life goes on.
And let me ask you, there's a follow-up then. So, one of the things, we had a show, we called it Adult Swim, because none of the hedges are working. You said before the show, you're hedged with refiners, which actually is a hedge. And so when you have a market like this where my bonds aren't working and gold's been not working and, the staples aren't working, how do you think about that? Because it's a different animal than other downturns, right?
Well, no single downturn is the same. They're all a little different, right? Look, if you told me we're going to have a Middle East war and I looked at my book the day before the war started, I would have told you that I'm going to be having a great month. And I'm down on the month. And it's incredible. Look, I think the biggest head scratcher to me isn't so much gold, because I think these guys in the Middle East, they're selling their gold to buy weapons. They're probably selling their bonds to buy weapons too, which is why it's not working. I mean, they need cash. I'm amazed Brazil isn't working. I mean, ags are up, energy's up. They just started a rate cutting cycle for the first time in a couple of years, and Lula's approval rating is in free fall. Like, all 4 things that work in Brazil should be working, and Brazil's coming off. So if I can't even get that one right, like, I have no idea how it's going to work. No, I mean, look.
I think that was a positioning problem, Kuppy. I mean, literally everyone we know was long Brazil. I mean, I'm out of LATAM at the moment completely. But I think ultimately it's the same reason that the GCC guys are selling their gold and their bonds, right? Everyone's just raising cash right now. But going back to it, I mean, I still get the sense that, you know, everyone is positioning for the rip back to all-time high right now, or mentally preparing themselves for that, and I simply don't get it. Right?
Right.
This was a market. I'm talking sort of broad-based US equities that was looking pretty sick from October, late September, October. It looks like it's been trying to top, and then we got a war poured on top.
Look, it's gone straight up for so many years, and buying the dips works so well that now we're going to buy the dip before it dips. Look, if the war ends, we can go back to where we were the day before the war, where we can worry about private credit and AI taking my job. Like, the best case scenario is we go back to worrying about that stuff. At least the war, look, refiners are doing well. Petrochem is good. You know, commodities are good. Like, you actually have some stuff working now in the economy. I like to joke that Iran did involution because the Chinese refused to. Come on, it's funny. It was true also. They can't export anything because they don't have any naphtha or ethylene or all these things. Like, we did, the Iranians did what the Chinese refused to. But like, I don't understand this. Look, I get it. You have like this like 5% snapback day, and everyone wants to catch it. Everyone's scared they're going to miss it. I mean, I could see this being down 25%. Like, I don't really want to go stand in front of, you know, that freight train. I mean, I'm always the most amazed at stuff like airlines, right? And like, they're barely down because everyone thinks they're going to be up 10, 20% the day this thing ends.
I'm guilty. We talked about this on Sunday.
We talked about that was our hedge. We're like, hey, buy some airline calls.
I said, sell everything you own, and if you're feeling FOMO, just buy some Jets calls.
But I mean, look, the airlines are going to have terrible numbers this quarter. They're canceling flights. Their route network got all screwed up. Gas, you know, jet fuel's sky high.
TSA.
I mean, TSA is a mess. I mean, who's going to book a flight? I don't want to wait 4 hours for a transfer. And like, these things should be down a ton. This reminds me of like the week before COVID, where like I was short all this stuff and it wouldn't go down, and I gave up, and then, you know, it just waterfalled. Look, I think it shows that people really, really want to buy the turn, and that's usually not when you want to be buying. I want to be buying when everyone's like pissed off. There's tons of despair. Like, everyone hates it. Like, it doesn't feel that way. And I'm just mostly, look, I'm not saying I'm making sales right now, because if you're going to panic, you panic first. Like that Monday when the market was down 1.5%, I'm saying to myself, we should be down 10%. Like, let's go make the sales. And then we rallied to unch, and I just kept making sales. So I already had the panic. Like, I mean, I sold them higher. Now I'm just kind of waiting. But no, I mean, go to your point on what happens. And, you know, I've panicked 10 of the last 2 times. But I'm damn glad I made some room into COVID. I made some room in 22 when the world fell apart and we had a down market. You know, I made some room in front of Liberation Day. You know, I just didn't buy them back on the way back up. But the first thing you do is you take your exposure down, live to fight another day. If you're 130 long and the market drops 20%, you're in danger zone. So, you know, you just take it down. I'm not saying you have to go all cash. I mean, I'm still over 100 long, but I just took it down.
And you know,
you're longer than me.
Maybe talk to the mentality of that, of like, you know, you're a hedge fund manager, I run funds, like you have this pressure to perform, right? And so people are always so scared of not catching that. And how do you like just be calm and say, hey, you know what? If I miss it, it's okay. I'll make it up in a different way. And maybe that's your style, but like, I don't know, maybe talk to that a little bit.
So I think it's really about how you structure your investor base. You know, we have almost 200 LPs in my fund. We run almost 400 million. And we have some institutional clients. We mostly have high net worth. these guys are in it for the longer term. They're not saying, Kuppy, you need to get every swing, every basis point. They're much more focused on like, hey, if the market's going to drop 30, do we sidestep it? As opposed to, do we pick up that 300 bit pop? We're not terribly correlated with the S&P either. So if I miss it and the S&P pops, there'll be some other trade that comes along. There'll be another trend in 2 weeks, and we'll just grab that other trend. Like I don't care what the S&P does as much, but I think it really comes down to the fact that if you have the right investors as an institutional investor, you can miss. I mean, it's not so much about the ups, it's really about protecting your downside. And it's been so good for so long, people forgot that protecting your downside is a big part of the job.
Yeah. I mean, go ahead, Rupert.
Yeah, no, I put together a couple of slides, Cups, and I think you have a very, differentiated approach to how you manage your book. And don't worry, this is everything you've said in the past. Don't worry.
No, this is good. This is really good. I like it.
This is the guys who are going to take the consultants' jobs. It's called AI.
It's a kaleidoscope of colors, man. It looks like you opened a pack of Skittles here.
So when you talk about, I mean, listen, we joke about VIX calls from time to time, but you really view cash as your core downside protector, right?
Yeah.
And knowledge and safety around a small number of eggs in your basket that you're staring at closely, to parrot Mr. Druckenmiller. Do you, if you put yourself into the head of the more traditional Wall Street money manager, where are these guys when they're dealing with these kind of markets, right? 10x the positions that you've got, wasting money on S&P downside to protect their tail, and just staring at the screen every day.
Right. Look, I think the way the traditional Wall Street guys do it, when you have 60 to 100 names, you are the index. And so they're basically running like a best of index. And it tends to be the like high quality compounders, as they call it. And so you have these like overvalued stocks that everyone kind of knows are good, but if you own them for long enough, they tend to, compound at a rate of, where their ROE is, and you get, revenue growth and everything else and buybacks. Like they tend to be good companies, but they're valued very expensive. And everyone tends to own them. So when things go bad, they tend to drop a lot. And they buy index protection, which means they kind of negate a lot of, the value creation of owning these sort of things. I think one of the things that's really important about being a private investor or, being, me, is I walk into the market every day and I say, we'll be down sometimes. Like I don't try to sugarcoat it and say we're not going to have any drawdowns. Like I expect to be down 35% once every 2 years. And if I'm not doing that, I'm not doing my job. Like we expect to have a nasty, nasty drawdown. And it's not really because I made a mistake and I, chose the wrong stock and it misses earnings and it's down 35%, though that, it's happened. It's really because I'm going to buy something at 10. I'm doing inflection investing. I'm doing stuff with lots of upside. I buy it at 10, it goes to 30, and then it ends the year at 20. And, you could say, Kuppy, you just gave back a third, and that's the truth. And I can say, but we doubled our money anyway. Who cares? And it's just going to be a bumpy, volatile ride. And I don't know how to hedge that. I don't know how to buy tails. I mean, my stuff usually is non-correlated to the market. Every time I buy S&P, I'm just betting on semiconductors and, Mag 7s. Like they don't correlate with my refiners, It's like...
what do you think's happened to, because you're talking about the old world of hedge funds, absolute return investing, right? I think that the growth of the pod shops has really changed how this market, everyone is obsessed by drawdown math, right?
Yes.
The 3% drawdown that gets the tap on the shoulder. And also the effects of these long short pods in the market has really made a mess of value investors looking out further than 5 or 6 quarters, right? So having a view on 2029 earnings in this type of market in US equities feels almost a little bit pointless.
It's quaint. It's old school. Look, I think these pod shops, they're the ones moving the market around. They're the ones swinging huge size. And every time they're long something, they have to be short something, which tends to be my names. Because, but they're totally valuation agnostic. They're going to be long the thing at 30 times earnings where the earnings are growing really fast. They're going to be short the thing that I own at 6 times earnings because the earnings are growing, less fast. And if you do it enough times, I guess they make money at it because, they have more money than I do. But it just depresses the valuations of mine things. And as soon as they, unwind their long books, suddenly my names go up. So it's weird. Like you have a down day like today, and a lot of my names are just randomly up on no news because someone who's short is having to cover because they're selling their long names. It's made doing what I used to do, which is trying to figure out correlations in the market, much more difficult and more complicated. It's made valuations and pricings so much more random, but it's created a lot more opportunity. The opportunity, though, is you have to look at 12 to 36 months. I would say that these things are more perfectly priced for what will happen next quarter than at any point in my life. There are guys with satellite data and credit card runs, and they have the CEO's roommate from college, at the pod shop as an analyst, and they know everything that's happening at these companies. And like mid-month, the Thursday credit card run was no good. Let's start selling it down. Oh, Friday's not looking good either. Now we're short. Oh, Monday, get a good weekend. Let's go buy it back. Like these things move around. And I have no edge in that stuff. It's not even clear these guys have that much edge at it because, they're making what, like 6-8% a year with like 4 turns of leverage on it, 6 turns of leverage. But it's created so much more opportunity if you're willing to look at something and say, you know what? I think this quarter is going to absolutely suck. I think the pods totally are right. I think, Q3, probably not so good either. But by Q4, it's going to turn. Like we know it's going to turn. We know who the customers are. We know who the suppliers are. We know what's driving this. Let's just buy it. And if it goes down because the earnings suck, we'll buy some more. But odds are when the number comes out and it's terrible, everyone's going to have to cover. And it might not even drop that much. And I don't really care. I think the important thing, I judge myself on a rolling 3. I think that's, for most people watching this are not pod shops. Like judge yourself on a rolling 3 year and just use the pods to your advantage. Take their alpha from them. They're the ones giving you the opportunity to buy these crazily, misvalued things. I think the other place with this huge opportunity right now is the sort of businesses where through a cycle, they have really good returns on capital, but it's super lumpy and it's random. So take refiners, which I'm long. I didn't know we were going to have an Iran war. I took more of a structural supply demand view that there's not a lot of supply coming. And if the economy does better, demand will overshoot. You'll have an elevated crack spread. And the crack spread was starting to inch up before the war. But the thing with
more than inch. The crack spreads were a gift for most of Q4 last year.
Yes, and
explode.
And that was the spots crack. I was looking at the 1 year out, December 26 and 27. Like that was starting to inch up too. And let's tell you that the Vitals of the world that run the big money, like they're starting to price the crack being stronger. So it was a good trade, and we were up quite a lot in this trade before even the war started. But I think my point is that the average pod shop can't own refiners. So the refiners started moving up in Q4, and then in December because of weather, the refiners, the crack spread came off, and they sold all their refiners because they went from we're going to beat Q4 estimates to we're going to miss Q4 estimates because the crack came off the last couple of weeks of December, and so the refiners they dropped 20%. So I just bought more. And then, suddenly January, the crack spread starts going up. These guys started buying it back. Like anything that has volatility month to month, quarter to quarter, these guys can't give it a valuation commensurate with where it should be. If you think the refining industry earns 15% return on capital, which is, what you'd expect for some industrial thing, like these things are really, really cheap still. The problem is it's going to earn like 30, then 5, then -2, then 30. And the pods can't just put it on and say, I'm going to own this for 5 years because it's going to compound capital at a really high rate and buy back a lot of stock at below replacement cost. But you at home can. And I think there's a great opportunity. And every time they sell it down, you either buy more or you do like I do and you just write puts. And it's like a free dividend.
Yeah, because, it's interesting. Like when I started at Fidelity, there was a lot more longer term analysts that would go in the game, and then the pods just like soaked them all up. So these smart guys there, but they'll tell you, hey, I can't look out a year because, I can't, maybe I don't keep my job, right? Like, so it's like, I need to be 3 months, maybe 6 months, but like it needs to be working. And there's just intense pressure on it for it to always be working, basically.
Right. I mean, look, Izzy doesn't pay you to guess what the 2026 average crack will be. Maybe Vital pays you. So Izzy doesn't pay you to guess the 2026 average crack. Izzy pays you to guess what next week's crack is going to be, and if refiners are going to be up or down 5% next week. And that's where the opportunity is. And I think with the supply demand, I mean, the crack's going to be elevated. Does that mean it's a 40 crack or a 30 crack or a 50 crack where we right now are in prompt? I have no idea. I think in all of those, range of outcomes, you make really good returns on your capital, and I think it's just going to be good. And I think my point is that there's a lot of opportunity for people who want to take advantage of the pods and their fickle nature. And there's a lot of companies we own right now where I think the Q1 results won't be so good, but I think the back half of the year will. They're cheap. I mean, this is something I've been doing for a long time, and I'm going to keep doing it. I mean, God bless the pods.
Yeah. So I want to hinge on something that you just mentioned. The key word there that you mentioned, which is replacement cost, and that's a big theme behind a lot of your investments. Whether it's the drill ships, whether it's the refiners, it's owning stuff that they're not gonna build any more of, right? It's massive discounts to, frankly, at times the value of their steel. How does that play into? I mean, I think you were the first person that called themselves the inflection investor, and I've put together, this sort of graphic of how you've described your process. So, I mean, from the perspective of let's just take the refining trade. Where do you think we are right now? Somewhere in phase 2 to 3.
We're in phase 2. It's definitely not the bottom. I mean, they're all up a ton. But I think there's extreme pessimism still. Everyone's looking at these and saying, well, if the war ends tomorrow, where do refiners trade down to? People aren't realizing that the market's structurally tight. A bunch of refiners in the Middle East just got damaged. They're not turning back on. Even if the war ends, I don't think, the crack just collapses. And I don't really care what next month's crack is. I think there's going to be really good and bad months over a couple-year ownership period. And it takes 5 to 7 years to build a new refiner. And they're not building anymore. And I think you're just going to earn very good returns on capital, and it's not priced in at all. I would think these things should trade at a premium to replacement cost because they're so hard to build. And as we've seen with Dangote, which, it's Nigeria, so it's got its own dumb problems, these things are hard to bring online. And, as we've seen with, Valero, sometimes you burn your own refinery down. I mean, PBF did it also with Martinez. So these things are difficult, and they deserve to trade at premiums, and they don't. And I don't see anyone talking about refining. I don't see anyone bullish refining. They go up every day, but I mean, I think it's mostly the companies buying back their own stock. I mean, they have huge buybacks, and if you buy back your shares at a huge discount to replacement cost, and it costs $25,000 to $30,000 a day to build new refining capacity, $25,000 to $30,000 per barrel flowing, and these things trade at what, like 7,000, 8,000. Like if you strip out some of like the midstream assets, you strip out some of the like terminal assets and stuff. Like if you buy something at a third of replacement cost and it's actually earning its cost of capital or a premium like it is now, over time you're going to make a lot of money. And I'm surprised these things don't trade at premium valuations because they should.
How do you think about the back end of the trade, right? You're averaging up all the way while it's working. Is this, wow, there are too many people talking about this trade alongside me? What is it that gives you the sort of spidey sense at the back of your head around when a trade is, probably played out from a Kuppy perspective?
Well, if you bought all my winners and held for 6 more months, you'd probably have the best performing hedge fund in history. I don't know why it is, but I find these things get expensive in my mind, and there's so much quant in markets, and stuff going up just tends to attract quant guys. Basically, it's like earnings estimates going up plus stock price going up, buy it. And these things just overshoot so much. But I kind of look at this and, there's usually 2 ways we get out of one of these winners. One day I wake up and I'm like, this is kind of expensive for what it is. If I'm not a buyer here, I'm a seller. And more likely, I find something really, really cool and I need 1,000 bips of balance sheet to go put it on. And I have two choices. I could go on margin, and margin's a bridge to somewhere. You still have to make a sale eventually. I don't want to just sit there on margin. Or I can go make a sale. And you go through your book and you have to throw one of your virgins into the volcano. And there's usually one that's kind of gotten a little bit old and fat, and that's the one you toss. And that's kind of how it works for these things.
So,
Kuppy, but
go on,
you
Ben.
know, Rupert and I were laughing beforehand. I'm always super early, like you. I'm the guy who buys energy in 2020. I like to buy stuff when it's absolutely hated, or I'm the top ticker. I notoriously I like to short when it's really the opposite side. But hanging into the trade is Rupert's strategy. He comes in the third inning as like a mid inning reliever, and he's out of the game by 6 or 7. How do you know when it's time to exit? Is it valuation? Does it feel wrong? Is it everybody knows the story? Like what is it that like really drives you to move on?
It's different each time. I mean,
yeah.
I'm usually like a second inning sort of guy. I never get to bottom, but I'm really early. And that's how I can reduce my risk. So when I get it wrong, and I get a lot of these wrong, I get my money back plus or minus 10, 20%. And so when I get it right and I get a bunch right, we're looking to make 3 times minimum. I won't do anything if it's not a triple, but I'm really looking for 5 and 10 X's. So with refiners, I don't know, they're up 50%, 75% since I got in. Like it's not like I'm definitely not that 3X. I mean, we underwrote it, just back of the envelope to be a 3X. I mean, and the trend seems like it's going pretty damn well. I think it'll just be obvious. Like one day you're going to wake up and, Valero's going to trade at $100,000 a barrel of refining capacity. And they're going to be announcing, a 25 billion CapEx program to add more capacity. And the guys in India and China are going to be just ramping. And you're going to look at this and be like, wow, we're going to have a glut of refining capacity in 2032 or whatever it is, 2034. And then, you have a 5-year ticking window that you start selling it down, but it takes 5 years to add any of this stuff. You can do some stuff on the margin, right? So, you can do less shutdowns. You can do some debottlenecking. There's things on the margin you could do to get more utilization up, get some, get 5,000 more barrels at your refinery, 10,000 here. Like there's stuff that they will be doing. I don't want to make it seem like it's an all or not.
I mean, they're all running at they're running at max capacity now, and things like that Valero fire happen when they skimp on the maintenance, right?
So the U.S. we run at max capacity. In India they don't. Those guys need to hire some Texans. Texans know how to run refineries. And look, I think if you look around the world, like when you look at this with an EIA number, it's balanced. It's really a balance, but the crack's telling you it's not balanced, and that's because the rest of the world runs at lower utilization than the U.S. does. And we've shut some refiners in the U.S. and in Europe that were very high utilization, and replace them with some other refiners at lower utilization. So there's some give and push still available here. But I think the trade ends. I mean, in every trade you enter, you have to know when you're going to end. It ends when a bunch of guys announce giant CapEx programs to build more refineries. I mean, coming out of 2008, they built so much refining capacity that all came online in 2013 to 16. And I mean, it didn't end until like 2018, all this capacity that came online. And it destroyed the crack. You had a decade where no one earned any money. This is commodities, right? And so until they add supply, there's going to be good and bad years in the refining market, and weather is going to happen, and wars are going to happen. And wait till they add supply. That's it. There's other trades where you could be like, hey, the thesis died because the technology changed or something else. Like until they add supply, I don't see how it ends. And so unless it gets really expensive, that's the way it ends, where it goes to where Goldman Sachs starts doing, their, refinery tour of South Texas, and a bunch of guys in suits are walking around at a refinery and everyone has 150,000 a flowing barrel price target because we're only trading at 100. Then it's like, yeah, it's kind of priced in. But those are 2 ways it ends.
That's quite a long way away now. I'm glad Benny mentioned energy in 2020. The whole, I have to bring this up. I know that you weren't completely responsible for the WTI 250 baseball caps. That was Josh.
No, that was actually my cap. We did those.
What do you think? What do you think happened to that trade, because I have to say, I'm convinced. I was as convinced as you were back in 2020, 2021 that, you know, crude was a one-way bet, right? And that was before Putin invaded Ukraine. That was before, you know, and then the trade disappeared almost as quickly as it emerged.
Yes.
And how I'd love you to describe your process of going, whoa, this isn't what I thought.
It was a nice Q1 though. It was a nice Q1 for you boys.
It was amazing.
22.
It was amazing. I mean, yeah. 2022 was a game of two halves. Let's call it that.
So was last year. So was COVID year.
Look, I think the trade ended because they are pretty good at producing a lot of oil out of the Permian, and they ramped. But much more importantly, all the world's central bankers panicked over inflation, and they raised interest rates. The Chinese lit their economy on fire, and the demand just froze. I have this macro thesis. It's called Feudalism, and it's literally driven by what happened in 2022, where the people who own the assets, that's private equity, private credit, that's, you know, tech stocks, VC, commercial real estate, they had an existential crisis in 2022. What happened is that basically all their assets went down in value. They don't own energy stocks. They own, you know, office buildings in San Francisco. All their assets went down, and then their cleaning lady and gardener wanted a raise, and they got squeezed on both sides. And they said to themselves, we're never going to let this happen again. We're never going to let basically the economy run hot. We're going to keep a lid on the economy so that the bottom 90% never can rise up, can never demand a wage increase. I mean, they're going to stay in their little favela, and we're going to keep them away. We're going to have our 10% that are going to help us in our corporate businesses. You need some people to run the thing. But we in the top 1%, really 0.001%, which is, you know, in the tens of thousands of people that own all the assets. I mean, we talk about the 1%, but it's really like the 0.001. It's a couple of basis points. And we're going to make sure that the economy never works. So like the middle of the country can't work, you know? So we need to have permanent like deflation so that assets can go up, so that interest rates can stay low. We're going to ignore the inflation. We're going to do a bit of money printing, because that's kind of how you grease the skids of this whole thing. Because if the money supply goes up, asset prices go up. But they had this existential experience. I mean, look what's happening right now. We're about to enter a recession driven by what's happening with this war, and Fed funds are pricing in that they're going to raise interest rates. Like that's insane. I mean, it's obvious that we're going to be, I mean, we might not lower rates immediately, but we're not raising rates. And we're probably in the back half of the year going to panic and lower rates because the economy is going to freeze up. And like, this is the feudalism. They refuse to let the economy run hot. They're going to try to, I mean, if we have 10 million barrels offline in Hormuz, they're going to destroy 10 million barrels of demand globally, which is an impressive undertaking, right? Because in the GFC, it was like 2 million barrels. I guess it peaked at like 5 million in one quarter, and it was 2 for the full year. Like they're going to do like a 5x GFC. Like I think they really do not like economic growth. They like when their funny assets like AI goes up because it's like fantasy multiple. But they really do not want real economic growth. They don't want oil up. They don't want soybeans up. They don't want the guy with the cement plant or the home builder. They don't want any of these guys doing well. And it's interesting because in 2022, those guys all did well. All the middle America, you know, the HVAC guy, like they were trucking. It was all doing great. And the middle class guys finally saw some wage growth for the first time in 40 years. And they were in a great mood. And the rich guys were in a terrible mood. And they said, we're going to keep these people down and send them back to the favela and let them be poor. We can't ever let them do well again. And it was an economic decision, just like having, you know, high interest rates, low interest rates, inflation, deflation. These are all economic decisions. You can solve for anything. And we as a country decided that we're going to solve for what makes assets go up, which is why Trump can't even execute any of his plans. Because every time he tries to do something that's supposed to help his core base, stocks sell off 2% in a day and he panics. And it's why everyone's kind of trapped in this box that you can't escape from. And I think it's structural. It's not forever, right? But it's a political decision. Until we change the guys at the top of the political decision, we're going to have feudalism. And so you should invest accordingly. And I don't know why I went on this tangent, but...
Okay, but no, but
once
if they are going,
you can't unsee
if they're going to,
the economic situation at play. You can't unsee it.
yeah, I mean, if they are going to force this demand destruction, then things like the refining trade is going to stop working, right? So how do you invest for the feudal age, right? Assuming that you're not prepared to pile on with the overlords in their AI trade.
So I saw refiners as being a hedge in case they actually run it hot. I actually saw it as a hedge to my book, not as a core book. If it had been a core book, it would have been bigger. It's still, pretty damn big. No, I think you're going to be in the things that they want to work. We own a lot of stock exchanges because historically trading volumes only go in one direction. It's lumpy, but they only go in one direction. They just keep listing more products to trade and they gamble more. I love stock exchanges, especially in the countries that are working. I like, brokers, settlement, clearing, all the things where the rich guys want to go off and gamble. Like, I'd much rather bet on Marex, which we're long, which is where the CFOs of public companies bet on the SOFR curve and hedge their own, interest rate risk or currencies. I'd much rather that than Robinhood, where the peasants go and, gamble on, Polymarket or whatever. But those are the sort of things I want to be in. I want to be in everything. I'm just looking through my book. I mean, it's all tied to being long asset values of the assets that I think the 0.1% want to go up. And it's done really well.
That was Dubai. That was Dubai until about 3 weeks ago, wasn't it?
I don't have much Dubai, thank God. But no, it was Hong Kong, which is probably going to win from Dubai. Look, I think you're going to have a couple of capital cities globally where the 0.1% want to be. Like, if the trend in play is the U.S. looks more like Latin America, which seems to be what's happening, then you're going to have most of the people live in their favela. You have a couple, 5-10% of the people who run small businesses, bodegas, that sort of thing. And the actual wealthy people are going to live in Miami. Rich Americans are going to live in Miami, but they're going to have their own Miami, which is special and cool where they want to be. And it's going to be Dubai. It's going to be, Monaco. I don't know, like name 5 places. Monaco's not going to be the capital of business, though. Dubai might. I don't think Dubai's out yet. I think Hong Kong's going to be the capital of Asia. Dubai is going to be basically neutral ground where the East and West do business together. Miami's probably the capital of the West. And I think if you have that sort of framework, just own those sort of assets. I mean, we're long Florida in a big way. I think Florida's going to keep booming. It just keeps getting net inflows of people, and especially getting the wealthier ones. You want to be where the rich people are going. But these are just trades, I think, that work well in this feudal world. And it's not just about going where the tax rate's the lowest, though that's going to drive a lot of this decision. It's going to be quality of life, too. And I think people want to be around their peers. I think you just belong to things, the places where these people are going. You want to belong to the asset values, that whole asset value trade, which is really just asset managers and exchanges and settlement clearing and all the pieces of that. And
I'll tell you what,
I have very little GDP.
It's certainly not luxury. I mean, you're looking at the drawdown in Ferrari and in the French luxury brand businesses.
That's like middle class stuff. I mean, that's what. Look, you get a Ferrari when you're a 65-year-old dentist, and you're like, I saved up a couple $1 million. I'm going to go chase some 22-year-olds. Like that's like upper middle class stuff. That's midlife crisis dentist. That's not 0.1%. That's maybe 1%, but that's a whole different world. And those guys are incrementally. It's like termites up the cap structure. Poor people have always been poor. We've shredded our middle class in America. That's a policy decision, remember. That's not accidental. That's a policy decision. Because the 0.1% can get richer if you outsource all these jobs off overseas. First, we did it in, smokestacks. Then we did it in basically anything you can move off to China. And now we're going to do it in white-collar stuff in an office building. Between AI and India, that's all going to be outsourced. And this is a policy decision that we made that the 0.1% are going to have better EBITDA margins on their equity. And so I think the incremental guy who's buying a Ferrari is probably going to be incrementally less likely to afford a Ferrari. He's going to get an Audi now.
Let me ask you this, though.
Or maybe he's just going to get a low-end Rolex. I don't know.
Let me ask you this, because I'm with you that AI and robots and, the whole trend of how things are gone does support your view. what could make it wrong? Like what could upend that trend? Like how could you be wrong, I guess? Like
Well,
just revolution? I mean, or what would it have to be?
This is a top-down political decision. Trump's won twice because people are pissed off and they want a different outcome. Unfortunately, Trump says the right thing on the campaign trail and then does nothing. I think we're going to end up with someone like AOC who actually really believes this stuff. And unlike Trump, if stocks drop 50%, I don't know if she'd care. She might even like it. And so I think this is going to be a political decision that's going to be made through the voting box. And we went hard right with Trump. We went hard left with Biden. We went hard right again. Now we're going to go hard left again. And after 16 years of this, if they can't solve it at either party, and I don't think they can because it's a uniparty system, Congress is controlled by 100 corporations that don't let them think for themselves. And then you probably just go to the guillotine. That's kind of what the French decided. And so, I don't think this is a good place to be going to, but I'm not a policymaker. I just trade stocks and I see the trends in motion. I think they stay in motion. Look, if AOC is about to win, you buy chemical stocks, I've been saying that for a year. And I think we're going to do this feudalism thing for a while more though, because you have a trend in motion. And honestly, you have a long history of this being the place where Latin America settled out. What's interesting right now is that Latin America has finally decided they're maybe not so sure about feudalism, and they're trying some pro-business guys. You've had Argentina, you've had Bolivia, Chile, and Latin America does this about every 50 years. It lasts for about 10 years, and then they decide they just want free stuff. But it's a good 10 years. You should be long LATAM right now. But I don't know. It's just interesting that they're going, more in the direction of free market and economic growth, and we're kind of going more in the direction of LATAM. And your money's treated best where it's treated best, and my money's in LATAM right now more than the U.S. But I really don't want anything GDP growth. That's I think the main thing. I don't mind LATAM GDP, but I really don't want U.S. GDP, and I really don't want GDP. Well, Europe's lost. I just want to be in the things that are working.
All right, let me ask you a question to get back to the process oriented. What was your worst trade and what was your best trade? You can remember. It doesn't have to be absolute.
I've been zeroed on so many things, or near zeroed, right? It's always that biotech thing, and it's 100 bips, and some guy that knows 100% of the work, and you wake up in the morning and it's like, hey, wait a second, this was $12, now it's like $1.20. They did one of those 10-for-1 reverse splits, those sort of things happen. But you play them appropriately, right? Look, I've gotten, in terms of the real stuff we own, I was long a company that was going into COVID. I think the biggest expensive mistake we made at the fund. It was a large position. It was a company called Altisource. It was a default mortgage servicer. It was based on the view that the economy was slowing in 2019. And that you'd see mortgage defaults uptick, and they make a lot of money if mortgage defaults go up because they service the defaults. And you don't have to go into what they do, but if defaults go up of mortgages, they make money. Is the nuts of it. And so you had 2 quarters in a row where defaults started upticking, and I bought it because 2 quarters is a trend, and I'm an inflection investor, and I bought this at some really silly valuation based on where I thought defaults would go. I didn't think it was like GFC. I thought defaults would go from 30 bips to 100 bips, something like that. And it was a really good way to hedge the rest of my book because it has a lot of operating leverage. And then COVID happens, and the government bans defaults. They say you're not allowed to default on your mortgage. It's impossible. Don't pay your mortgage forever. Nothing bad will happen to you. And I wake up in the morning, and my largest position has no reason to exist. The government took their business away, and you can be angry, or you can just hit the sell button. And pre-market, I was already selling. And I had some friends who were long the stock. They're like, Kuppy, what are you doing? It's down 30%. Down, you're selling down here? This is unconstitutional. This is illegal. They're gonna win in court. I'm saying, get me out of the whole thing. I want to be out by end of day. And I had too much, so it took me 2 days to get out. And I sold it down 40% or 50%. And then I don't know, 6 months later, it was $1. I started selling when it was $15.
Yeah. That's a good trade.
That's a great trade because I would have lost it all. And look, when you're wrong and they change the rules on you, you don't argue. I had friends and look, they actually sued. They won. It took 2 years to go through the court system. And they basically did like 2 capital raises before they went back. Like, what was the point of winning? You know, the whole point was be half the volume until you're out. And I just slaughtered the thing. Like, I mean, we were like half the volume that day, or some crazy disproportionate amount of the volume that day. And I just smashed it. And I think if you're going to panic, you panic first. And when your thesis dies, literally with executive orders, get out of the way. Like it's over. So I mean, look, that was our most expensive for a large position. Like I said, we've had a lot of things, but for a large position, that was my most expensive mistake. I lost like half, give or take. But I could have lost a lot more. And in some ways, my best trade too, because we saved the other half of the position.
Yeah, that's the best way to frame it. The best way to frame it. Talk about a winner, Kuppy. We're not just doing losers.
Oh, we've had so many winners here. There's been so many winners. Let's talk about a company, big winner for me. It was a company called Cornerstone. And they made housing components like siding and windows and stuff, right? Everything that goes into a house, they have a piece of, molding. And it's like a dumb business. It's boring as hell. I've been following it forever as a value stock. It was controlled by private equity. And you'd go to these conferences, and it wasn't a big company. It was like $1.5 billion, $2 billion market cap company in like 2019. And you go to like these industrial conferences, the CEO would be like, "Hey, Kuppy, like come on over. Let's get our annual Cornerstone update." So I'd sit there and you listen for an hour about how they're merging these 2 plants, they need to get some synergies and blah blah blah, and like they had decently high returns on capital for a sort of commodity business because they were so large in the housing thing. And it was cheap. It was like 6 times cash flow, but it was just going nowhere in a hurry. And I'm a value investor that I like buying really cheap stuff. But I'm not a value investor that I buy cheap things for the sake of being cheap. I buy cheap things with huge tailwinds. And I want to know that the earnings and the revenue are explosively growing. Cat 5 hurricane tailwinds. Like, yeah, this was growing a couple percent a year. And it was like, buying some competitors, blah. So, but I followed this thing for years. I knew management really well. And COVID comes and this stock drops from, I want to say like $15 to like $3. Like it's a highly levered, private equity controlled it. They took it public to delever. Like it looked like it was on last legs. I know the CEO, and he's a pretty conservative guy. And I see him just buying like nonstop, like $1 million a week, just buying and buying. I'm like, okay, I've got to know this guy. He's like a middle America conservative guy.
Can I interrupt you 1 second on that? Just to pause on that, which is, how do you protect yourself from the CEO charm trap, right? There's a big school of thought out there that, getting too close to management and CEOs are great salespeople, right? How do you protect yourself from that relationship trap? You
don't talk to them. I hardly ever talk to CEOs. I don't mind talking for like 10, 15 minutes, but I'm not one of these guys that gets like a monthly update. And CEO reach out, and Kuppy, you want to get a call? We just had earnings last week. It's like, I read the press release. Like, I get trapped sometimes. There's been some CEOs where I should have fired them a while ago, like fired the position I'm in, and I like the guy, and I thought he had a good handle on things. And there was always some dumb excuse each quarter why it didn't work. And it would have been better if I'd never talked to the man. Actually, the better way to do it now is I have an analyst. So the analyst takes the hour-long call, gives me the 5 bullet points, and I don't have to. All I see is black and white bullet points. It's 25 words on 5 bullet points. Like let him judge. I don't have to like be taken in by his aura, his charm. I just get the bullet point. But going back to the Cornerstone, I saw him buying a lot of stock, and then interest rates were 0, and you start hearing that housing is doing well. And like housing demand is exploding, and it's like one of those exempt industries, because like germs can't impact you if you're building a house. You can't possibly get COVID if you're on a job site. Like, so I mean, it was just pretty obvious that housing was working, and it was because it traded down from like $1.5 billion to like 500 million market cap, though it had like a couple billion of debt, so the EV was higher. But that also means you have huge operating leverage if it doesn't go bankrupt. And given how much stock he was buying, I assumed it wasn't going bankrupt. So we bought a lot. I made it a very large position. And I want to say 18 months later, private equity bought the half they didn't own for a 5x. But it was a really large position for me. So coming out of COVID, it was just like powering my numbers, right? Because it was such a large position. It was a double-digit position. percent-wise. So you get 5x on like a large position like that, especially, digging out of the hole of COVID. And then, I was so pissed private equity stole it from me. It's funny because I think the bonds trade at like 30 cents of the dollar now because housing sucks again. But they actually got sued for taking it private. A bunch of guys got together and litigated because there was private equity bought the half they didn't own. It was a related party. I think they won like an extra 100 million or something. But anyway, it's just like a great trade because when you look at a lot of the things I do, I have what I call the shit list, where it's all the industries and sectors and companies that are reasonably good businesses. Like we're not looking at steel mills or something. They're like reasonably good businesses that just nothing's really happening. And there's a couple hundred of these things, and you come back to them once a quarter. And you're like, is anything happening this quarter? No. Stock's up 30%. Something's happening here. Like, let's dig into this one. Like this something's happening. So this Cornerstone was on my shit list, and I knew management. And then something happened, and we were really fast to catch it because we were just eyes on it. And I'd say a lot of the things we own, it's very rare someone calls me up, hey, Kuppy, you've never heard of this stock, but you need to learn about it. It's more that someone calls me up, it's like, haven't looked at it in a couple of years. That's interesting. Haven't thought of it that way, But it's on my shit list. I know it. It's usually something we've already been hunting for a while, if that makes sense.
And so then patience, sometimes it's patience. Sometimes it's just you out surfing or at your farm and you forget about it and it's just luck. But it's the built up context knowledge that we have from doing this for 20, 30 years where you come back to it and you're like, oh, I remember you, friend, right? And you can get back involved.
Yeah. Look, I've been doing this almost 30 years now. I started in 97. There's a certain amount of muscle memory because this is like my fifth or seventh Mideast crisis of my career. This is like I've been through 2 housing plays. I've been through 2 uraniums, like a couple energy. These things that just repeat. Like how many fertilizer cycles is this? And so I kind of know my way around. I know the landmines. I actually know a lot of management teams. So it's very quick to figure out what I'm missing. And you get up to speed in a hurry. And they kind of look the same but different. It's like, if you think of Gulf War I, we invaded, energy prices collapsed. But we cut interest rates before Gulf War I. So it's different, the same. Fertilizer didn't work with Gulf War I. Each one of these is going to be there's similar but different. There's Gulf II. There's what was it 12 days where Iran and Israel traded rockets. They're similar but different, and you just need to pay attention and figure out where you think the market's not paying attention, if that makes sense.
So I sort of happen to think that one of the biggest risks to the equity market, to the US equity market's got nothing to do with the war right now. It's what happens when you try and drop $75 billion of SpaceX at a 1.5 or $1.75 trillion valuation. If the buybacks are falling away, if people are getting fired from white collar jobs, so the 401k flows aren't coming, how does this deal get done?
I don't know. I mean, there's a lot of things I don't know. It's kind of crazy, right? So there's this chart of equities, equity earnings, S&P earnings, and it's up and to the right. And historically, when earnings estimates go up, you buy S&Ps. That's just been the history, right? Except for it's really weird because cash flow and earnings per share are diverging dramatically. And historically, when that happens, stocks usually crash. And I see that one chart of S&P earnings going up, but no one ever shows you the chart of cash flow. It's in free fall. I don't know. I think we're going to crash. I'm super bearish. I think a lot of this tech stuff is really overvalued. I think a lot of it's going to go away with AI. I think AI, will cost millions of jobs, but it'll also create a huge lack of revenue because you don't need a lot of this tech stuff. You'll just AI it. And so the revenue will go away, the consumption will go away. I think the remaining employees don't want to get paid in SBC if stocks go down. I mean, it's great to get, RSUs, but you can't take RSUs to the grocery store when they're worth half as much. And people will say, hey, pay me cash now. I kind of want cash. And then suddenly, this all EBITDA X SBC just becomes hey, we're not really very profitable if we pay people cash. And so I don't know. I think, the multiples re-rate. I mean, it's weird. A lot of these software stocks, I spent some time looking at them because a lot of them are down by half. It usually gets me interested. none of them are really cheap on like current earnings or forward earnings. If you look at their own internal like 2030, earnings estimate plan, they're not really cheap. And then it's like, well, you're probably not going to hit your numbers because you're going to get AI'd. And like, I don't know, like I'm surprised at how expensive a lot of this stuff is. I mean, there's a whole school of investors out there. I call them the compounder bros. And they buy the good quality forever stocks. And suddenly Walmart's growing at like single digit, it's 50 times earnings. And you have things like Nike that's like 50 times earnings that's not really growing, it's shrinking, or Starbucks, which is definitely shrinking. And you look at these things, you're just like, who the hell owns this stuff? I mean, everyone always wants to talk about how Tesla's overvalued. And yeah, it is and it isn't. I mean, depending on what crazy dream Elon creates. But like, where does Starbucks fit in? Like, I'm a guy who drinks a lot of coffee. The average coffee drinker is either going to go for a $1 cup at Dunkin' Donuts or a $10, super fancy Yemenis cup. And the thing in the middle is worthless. And that's why they can't comp. And I don't know how you fix the problem. And when you're not growing anymore as a business, you're worth 7 times earnings.
Yeah.
Especially when you're probably impaired going forward. And so I don't really understand, like, I can name you 50 to 100 of these S&P 500 companies they're not like AI losers, really. They're just kind of like generic losers. And people just own them too much. And I'm kind of baffled by it. But I mean, I don't short it because as long as this fund flows in, you have to buy more Starbucks. I mean, and that's just the nature of the thing. But I think way too many people are trying to fight this or rationalize it. Or I just say, where's their cheap stuff with big tailwinds? I just go there instead. It's easier than trying to guess what's going to happen, because you'll be right eventually, but it might take you through 5 to 10 years of suffering first.
Yeah, and we had Mike Green on here, and he was talking about his passive thesis, and I think that's what the compounder bros really are. They're just kind of riding that wave on their compounder bro surfboard, and because what is the S&P? It's really a momentum strategy, right? Kicking out the losers, buying the winners more, overweighting, and so I think that's kind of what it is. Because I know these guys, and they don't like thinking. They're just like, stick with the fundy compounder bros, and like, if you think about the better strategy, right? Is it just finding names that are illiquid, or do you find often mega caps that you like, if it's not 2020 energy or tech in 2022 or recently software? Well, I guess not software, but you know what I'm saying.
I mean, I'm buying refiners. I bought them at a 50 billion market cap.
Yeah, okay.
They trade a couple $100 billion a day. I mean, I bought the Brazilian stock exchange. It was 20 billion market cap, trading $100 million a day. Like, you could buy a Hong Kong stock exchange. It's like a 60 billion market cap, 50, 60. Like, there's mega cap things you can own here. Like, these things are really cheap. I don't think you need to go buy illiquids. I mean, usually when I buy something illiquid, I get it wrong and then I'm stuck. I'm not saying go buy illiquids. I mean, there's a school of thought that if you buy stuff below 500 million market cap, it's undiscovered. Trust me, go on Twitter and type in any ticker. There's a little mafia in every single company, and they're passionate, and all they want to do is talk about their one stupid company. Like, everything's discovered, right? There's too many equity bros, and there's not enough CUSIPs, really. That's not the problem of it being undiscovered, is that it's bad. And if it starts getting good, guys will buy more, and it'll work. I don't think you need to go into illiquid or small cap. There's really large things that are doing really cool things right now. I can name you lots of these. Like, I think there's a lot of stuff that's horribly mispriced. And yeah, Mike Green has been right about this thing, and it's been frustrating because it's made my life hell.
Same.
And he's been right. I mean, I think it's really interesting to look at Bill Ackman. He's had a great track record. I'm not trying to take anything away from him. And I'm not trying to say being down 20 is a disaster by any means. I mean, I've done that many times in my life, where I'm down 20 part of the year. Like, as I said, I intend to be down 35 peak to trough at least every 2 years. But when you look at what he owns, these are the not really growing 50 times earnings sort of businesses that are really high quality businesses. And suddenly they're re-rating, and none of them seem cheap still. Like, and if they dropped another 20%, I'm not sure they're cheap yet. And it's just kind of odd to look at a book like that. And like, he's got a couple extra zeros to his name than me, so it's hard to criticize him. But you kind of look at it and it's kind of like, And I know there's a lot of guys that have similar strategies that are in similar sort of companies. And I don't know why you don't go buy things that are growing really, really fast at 7 times earnings. It seems easier. I mean, it's easier for me. I don't know.
I think maybe it's because people like straight lines that don't have much volatility. I think that it's just the trend. You stick with everyone's kind of an undercover trend follower, Kuppy. I think when you're like guys like me and you who are willing to go against the grain, it takes a different kind of mindset. Honestly, is where I think that comes in. And there's less of us now.
Yeah, there's less of us. I mean, it helps when you're trying to raise money. I mean, he's running a lot more capital than me.
Yeah,
my numbers are better. My numbers are better than his, but he's doing it with a couple extra zeros, so he's done better. He's got a PJ. I don't.
One day, buddy.
One day.
Well, he might be about 5 minutes away from squealing if it's 20 so far this year.
Oof.
I think he'll have strong views on the Iran war within a couple of days.
I haven't seen the 100,000 word thread yet. It's coming.
Well, because now you can do it in 1 second with your LLM. So now he's got competition for those 100,000 word tweets. There's now inundating Twitter.
Yeah. I mean, look, we haven't said enough about AI, and I'm sure you've already done it. And Citrini did it, and then everyone talked about it for like a month until the war started. But I don't think people are pricing in enough of the fact that a whole lot of jobs are going away. And I'm very much of the view that, this has happened many times in the past, and there's some new business that's created, and the jobs get absorbed, and productivity leads, society forward. But like the Industrial Revolution was 200 years, and people had time to like reskill and retool. And here we are. This is all going to happen in 10 years. We're 25, almost 30 years into the internet, and travel agents got replaced by Expedia, and they found some new job. Like this is going to happen so much faster that I think it's really going to be difficult for people to retool and get where they need to be. And I'm not saying everyone needs to learn how to weld, though you're probably going to get paid more if you know how to weld. But I literally don't know what the job is that replaces this. We don't need that many people to weld. We're going to need some more people in hospice to wipe grandma's ass, but you're not going to get paid for that. Like you have a lot of white collar guys making good money living in cities. And I don't know what Medicare pays you to wipe grandma's ass, but it's not anywhere near.
Yeah, I mean, like yesterday at Kuppy, just so you know, I'm involved with a next gen AI company, so I've been deep in this. And I was talking to one of my buddies who actually lives in Miami, your hometown, and was showing him how to use the Perplexity computer. And of all stocks, he picked ET. We had the model build in like 6 minutes. And I was laughing. I was like, "See, buddy, our jobs wouldn't be there 20 years ago. You remember how long it would take us to build a model of this quality?"
I mean, I've seen it at my own firm. I mean, we have one analyst now. We had 4 analysts this time last year. We cover more ground because I wasn't having my analysts build like Excel models because I don't really care about Excel. Like anything I invest in, the best case, worst case, play it out 3 years. The range of outcomes. So what? Like we don't do that. I do more of the hey, write me. Figure out the last 10 refining cycles. What started the cycle? What ended the cycle? What were people talking about at the time? Like, what were people thinking? When did the cycle end? Like, I'll have 100 questions about, because I'm a cycles guy. Like, what did the last cycles look like? And you'd have to go into like microfilm to look this stuff up, or you like screw around in Google for a week and they come back to me with this white paper. And now AI just like spits it all out. Like the refining cycle of the 1970s. This is what happened. It's like, like that's impressive.
And what's more impressive is when you get the AI agents to talk to themselves. We did a thing on the Iran when it's first started, and I actually was over in Dubai, so I was a little worried. And you just talk, like the different models talking to themselves, and then they come out with an analysis, then you drop it in a notebook LM, and then you got the pitch book. Like, it's pretty crazy.
It's incredible, right? And
it's crazy.
So we're running with less people. I mean, we're going to use less legal expense, less compliance expense. We're going to be able to do more of this in-house. Like, if I'm paying less in legal, like that's some lawyer that's going to need billable hours somewhere else, except all my friends are doing the same. Like, I don't know how this is going to work because, I mean, we're using those really expensive lawyers too. I mean, they're going to go from making, what is it, $1,000 billable hour dealing with me about my stupid compliance to wiping grandma's ass. And they get paid, what, $12 an hour? Like, I don't know how it's going to work for the economy. That's why I want no GDP.
So where are the revenues to support this capex? That's that becomes the problem.
It's just the savings.
There
it's
is no
savings,
revenue,
right?
No, I don't think No, because everyone's like, oh, well, you're going to get rid of a few $1 trillion of SG&A in payroll, and that's how you're going to pay for the data centers. But if you look at where the models are today, even like the free version gives you enough. Like the free version today is what the really expensive one was 6 months ago. And a year from now, I mean, the free version is going to be better than the really expensive one today. Like,
Yeah.
so you're going to get the free thing and you're not going to pay for it. And there's still going to be some venture capital firm that's going to give it away for free. It's going to be like remember when Lyft and Uber were trying to see which one was going to be the winner? And it was like $8 to take an Uber from the airport to my house. And the taxi was like $40. And they just basically VC subsidized it for like a decade. I mean, look, Uber has what, 50 billion of retained losses since inception, even though it's been profitable for 2 years. Like, this is how AI is going to be. They're going to subsidize this forever.
Yeah, and it's definitely subsidized right now. I mean, without question. Yeah. But the other thing is,
it's funny you should say that. So on Perplexity, so I pay for the pro version, not the full version, but they've started to give me sort of freebie tokens on the computer.
Yeah, exactly. And they want to get you using the computer.
As soon as you're on the computer, you see the meter of your token usage, and you go, I see what you're doing here. You are sucking me into being a token junkie. No, and I'm going back to the old Perplexity right now.
That's exactly what it is. I got the Max right when the PC came out because I didn't want to install OpenClaw, and this was just an easier way for the average guy. And they gave me like 35,000 extra tokens. Well, let me tell you something. It's real easy to blow them. You start making montages for your dad's birthday and all kinds of stuff. But yeah, I think that's right, though. I think they're trying to subsidize it, right? And then, so Kuppy, how do you see it all playing out with that? I mean, are these IPOs that are coming? Will that be kind of the top of the cycle, as Rupert thinks? Too much supply?
Yeah, maybe. Or maybe we just top before then. I mean, I've always been amazed. So, like, when I started in this industry, retail was the dumb money, and the pros, were like the smart money. And sometimes the pros lose for a couple quarters, but eventually the pros win and retail loses. Suddenly retail keeps winning and the pros are the dumb guys. Remember like 6 months ago when they were saying like, oh, you're allowed to buy private credit in your 401k now. And everyone's like, oh, everyone's gonna dump their bags on retail. And here we are, retail's bought no private credit. They're the first ones at the door getting their redemption requests in. Like they know like, you're gonna sell the liquid stuff in the first 5-10% and you'd be stuck with the dogs. Like they're the ones putting their redemption. And the pension funds are still having a committee meeting about when they'll have the next committee meeting about having the committee meeting about redeeming. And like the doctors and lawyers, like they've already gotten all their private credit money back. Like, I don't know. I don't think these guys are actually going to buy this shit. I really don't.
I mean, it's a lot of and maybe you're right. Maybe the big shadow bank that got like evolved after the GFC just got too big. And then, the other side just doesn't have the paper. And, Rupert wrote a letter to the NASDAQ because he's so pissed about what they're trying to do with the allowing space.
Crazy.
Right?
So it's all three indexes now. So the S&P and the Russell, they're all going to fall in line. They're going to try and dump this into the ETFs.
Well, it's the only way they can get it done. And yeah, my poor dad who just hit 80 he's going to own this in his retirement account, and he doesn't want to own it. I'm sure if he had the choice, he wouldn't own it, but he doesn't have a choice, and so he's just going to own it. And I don't know, it's dumb, but it's a corrupt game, and the big guys always win. But I don't think the retail is really lining up to go buy these unprofitable things. Maybe SpaceX is super cool, but I get the impression this AI stuff retail is way more skeptical of. And they've read the articles, these things don't make money, and they know it's not going to have a future. I think SpaceX, people are like, that's kind of cool. I can see where this is going in the future. It's kind of a monopoly business. But like, what's the fifth best?
It's a vehicle for the best stock. It's the vehicle for the best stock promoter on the planet, right? I mean, that's the only thing sitting in the buy cord, as far as I'm concerned.
Well, I think SpaceX is a business that's worth something. It's probably just not worth $1.5 trillion,
Yeah, no,
right? I don't know if OpenAI is worth anything. If it's never going to be profitable, it has no path to profits, and it's losing, what is it losing, like $1 billion a month right now? Like, maybe it's really worth zero. And I think that's very different than SpaceX, where it's worth less than $1.5 trillion, but it's worth something.
Yeah, I think that's right. I mean, so Adam Jonas, you know, the big sort of Morgan Stanley cheerleader for Elon, who sort of transitioned from automotive coverage into space coverage about 18 months ago. Wrote this big piece where he put the revenue TAM for space in 2030 at $1 trillion. Now, I'm prepared to concede that SpaceX has a 70% market share of that TAM. You know, it might even be 90% share of that TAM. But that is still this aspirational valuation, 1.7 times revenues for the entire industry 6 years out, right? Which you know, takes some math to get comfortable around.
Yeah, look, it's crazy, but dreamers will dream. And betting against Elon Musk has been a losing proposition for everyone who's ever tried it. And so, look, I'm very much of the view that there's a lot of things that are really in the too hard pile, and there's some things that are just really easy, and I just go to the easy places, and everything else is just kind of whimsical and funny to watch. But
I seem to remember, Kuppy, you were trying to risk guard the Twitter take private. So does that count as betting against Elon Musk?
Which the Twitter?
You're betting that he'd have to buy it. For you remember the Twitter risk?
Well, I made good money on that.
That's betting against Elon Musk. You see, it can work.
No, I think Elon wanted to own the asset. I think he was trying to retrade it for a better price, but he genuinely wanted to own it. And I think that's a difference.
Fair. Well, listen, Kuppy, we need to get you to the finca and hacking down coconut palms. Thank you so much for joining. Really, really appreciate it. And we will catch you on the interwebs.
Thank you, guys. It's been fun.
Yeah, it's fun. Thanks, bud.
That's such fun. Benny and the Squirrel and Kuppy out.